Welcome back, everyone. Up next, we have Riccardo Rebonato, Professor of Finance at the EDHEC Risk Institute, and he's going to be speaking on the topic of factor investing in the time of quantitative easing. Really looking forward to this. And if you have any questions for Riccardo, make sure you get it in. Over to you, Riccardo.
Thank you very much. Good afternoon, everybody. And I listened with great interest in the exchange of views that has come just before me. And David says something interesting. He talks about the opinion, the dissenting opinion from the guy at the back of the room. So to some extent, I'll try to be in this presentation the guy at the back of the room with a somewhat dissenting opinion. And as I've been introduced, I am, after 20 years in the financial world, I'm back in academia. And therefore, I'm going to start at least from an academic perspective. And factor investing and beta investing and smart beta, etc., is everything about factors and about rewards for factors. So let me start with something that has been keeping me awake at night. So the disconnect between what we are teaching our students and the way the world seems to be working at the moment. So let me begin from the correct version first. So what we teach our students is prices are discounted expectations of future payoffs. Discounted, so how we discount, that is where the risk factor comes in. But first we form views about what we expect the payoffs to be, and then we see how risky these payoffs are in some particular sense, and depending on this risk, we discount them back. And also we teach them another very important thing. We say excess supply and demand does not affect financial prices. It'll affect the price of shoes, it'll affect the price of cars, but not the price of the prices of financial assets. Because if there is an irrational demand and an irrational supply, there are always the smart guys with big shoulders that can come in and bring the prices back to fundamentals. And if I can encapsulate, and this is now really important for the discussion that I'm going to have in a minute, what are really true risk premia? The risk premia are compensation from being paid well when you don't need the money and being paid badly when you do need the money. This is really the key, the only raison d'etre for a true risk premium, for a true factor. We call factor almost everything at the moment, which could be one of the causes why factors have not been performing very well, because we've been calling factors things that are not factor, but it is really, really key. If something is a true risk premium, amongst other things, it does not disappear when you observe them. There is no quantum effect. It's simply, yes, I discovered a new factor, and I've just discovered that if I load up, if I create this long short portfolio, which is a specific exposure to this factor, I will make some extra money, because in certain situations when I would like to have the money, this portfolio does badly. That's what a factor is. And the other thing that we teach our students is that if an asset has a negative risk premium, well, then you've bought insurance. You don't get to get a negative risk premium unless there is an insurance element. And let's go back for a second. Can excess demand for financial assets affect their long-term prices? And the standard argument is no, because again, there are rational investors, and if there are irrational ones, there are bigger investors, bigger shoulders, and bigger capabilities that ultimately should bring the things back to fundamentals. These type of arguments were almost correct. There are always qualifications here and there, until quantitative easing really come in with gusto. And after 2018, after 2008, the financial world has been a completely different place. Central banks are different. Central banks are not just the other guy. Central banks have the ability to print an unlimited amount of money. They might not want to do so because of inflationary concerns, and we can go in a long discussion with the modern monetary theory, etc. But certainly, central banks are different from other players. So the moment central banks enter this space, all the considerations that we have been teaching our students are put, there is a big question mark. And that is why I make a distinction here between temporary, semi-permanent, and permanent price distortion. Temporary is just the ebbs and flows of supply and demand. Semi-permanent, you can see when there is, I don't know, a regulatory change or some sustained wave of buying or selling of some securities, but ultimately, if the fundamentals don't change, it should go back. Then we have the permanent price distortions. Let's take a look here. I have a chart, which is not a particularly elaborate chart. This is just a behavior of the S&P 500 from the pre-COVID days to very recently, just a couple of weeks ago. And if you look at the level of the S&P 500, is a tiny bit above where it was before we were really worried or we knew much about COVID. At that point, when I have this point there, COVID was just something that was happening in China. There was nothing to worry about. Now, why have I put this chart on? Because it is a bit of a paradox. Let's try to think. Discounted expectations. After what has happened all over the Western world and all over the world, and it is still unfolding because we still don't have a vaccine, we still don't have a cure, why would the expectations of future cash flows be any better? Certainly, surely, the expectation of the cash flows have got to be worse than what they were before COVID. I would argue they were already rather stretched, but let's leave that to one side. I can see no argument why, for the market as a whole, expectation of cash flows can be any better. What about the discounted bit? Well, the discounted bit should have to do with risk aversion. And I would say we have discovered a lot more risk to the economy after COVID than we did before. So on both accounts, I would not want, it doesn't make any sense to me that this green line is, well, let alone at the same level, but even a tiny bit above where it was in a pre-COVID world. The other side of the coin, I can look here at the 10-year Treasury yield. And we always say, it can't go any lower, and it always goes lower. And we now have 10-year Treasury yield is hovering around 60, 70, 80, 50, 60 basis points. All the models that you can run to work out a risk premium associated with 10-year, 7-year, 5-year. At EDHEC, we have a risk premium monitor that is available to everybody to go and look and see, and I think it is really state of the art. Everybody agrees anyhow, the risk premium is negative. So it is the only sense to buy these securities here, negative risk premium, as a part of insurance. So if you say, if I look at my expectation of a Fed fund rate, and I look at the 10-year Treasury yield, most of us, unless we are incredibly bearish, probably think that the Fed fund rates over the 10-year will be a bit above 60 basis points. Let's leave convexity to one side, which is just a nuisance at this point in time. So the only way to make sense of this is a negative risk premium. Obviously, people are buying treasuries as hedges of their other risk, their equity portfolio. Now, this has big implications for true factors investing. So, first question is factors. We give a name factor to almost to everybody, to everything. Every strategy that is every curve that goes up, we call it a factor. Well, that is not really. That is I would say, an undisciplined use of the term factor, and we shouldn't be surprised if that things don't work as we were expecting to. Factors, again, should be compensation for the fact that you get paid well when you don't need the money and badly when you do. Then when you find factors like big versus small, market capitalization, one thing or another, since the human intuition and human imagination is always great, we always try to find a way, or academics trying to find a way to link these criterion, that they are unmeasurable criterion, to what is called the covariance of a payoff with your consumption. But these things are really, really, really strained. And that is why at EDHEC, as I have been looking with Lionel Martellini at factors in fixed income, And we try to make sure that what we call factor is something we call a value factor. It really behaves like value. And, there has been a very famous paper, Value and Momentum Everywhere. And they say, we find value everywhere. We find value in treasuries. And you look at the definition of value and you say, oh, this is the 5-year performance, the 6 months performance minus the 5-year performance. You say, what doesn't look value to me? Why do they call it value? And they say, if we look at this in equities, well, in equities, there it was linked with value. Well, I'm not very surprised that these things are so stretched and so pulled at the seams that they crack at the first situation of stress. So, real factors at the moment are in real trouble, because the classic view says that risk premia are compensation for exposure to bad states of the world. Even in the classic view, there is allowance for pragmatism. Risk premia are a bit of balancing items. You can have regulatory distortions, segmentations, various frictions, etc. But the meat, not the side dish, should be the compensation for exposure to bad states of the world. Now, the point I'm making is that the QE distortions are so big that they've become larger than the phenomenon. And the QE distortion, I think it is something which has become very, very deeply ingrained. This is from the Fed itself. Is a publication is called Page One, and it is produced by the Fed. And it starts saying, what does the Fed do? And you can read all this passage here, and it talks almost about everything. And there is just a very small, the word inflation doesn't appear. There is just a tiny little reference to stable prices. But otherwise, it seems that the Fed does everything to keep the economy going. And by the way, if we manage, we'll also do something about inflation. Now, this did not used to be the mandate of the Fed. I'm not saying that is wrong. I'm not saying that is right. After 2008, central banks have been faced with situations they had never faced before, and perhaps that is making the best of a bad situation. However, the change in monetary stance is remarkable. At the recent Jackson Hole Symposium, Chairman Powell made a very clear statement. This is the end of the preemptive monetary strikes, which means we are not going to raise rates if we see pressures forming in the economy. We are only going to raise rates if inflation rises. You must see the white of the eyes of inflation before rising rates. Under this policy, the 2015 tentative rate hikes would now not take place. On the other hand, the Greenspan put is alive and well. And by Greenspan put, I mean the policy that whenever there is a turmoil of any shape or form in the economy, the Fed will ride to the rescue. This has huge implications for the yields of Treasury, which are going to be lower for longer, because there is an intrinsic asymmetry. The only good positive surprise that we might get is a COVID vaccine. That is the only big possible upside. Otherwise, surprises tend to be a lot more negative than positive, when you have had the last time a great positive surprise. So there is an intrinsic asymmetry that the embracing of a Greenspan put creates an unbalanced asymmetric behavior to rates. And it's not just Treasury yields, but by substitution, there is a ripple effect on all asset classes. This is something that I watch very carefully, and I've published again with EDHEC a paper recently, and it is again estimating the risk premia in treasuries. And this is a graph of what is called the last blue dot. We all know the blue dots. People in fixed income look at them with religious attention, and it is the expectation of members of the Monetary Committee or where the Fed funds will be in the long run. And here I have a median. And since 2012, we have gone to a 4.1, which was lower than the historical average, but not a million miles away, down to 2.5. Now, this data doesn't include COVID. If we put COVID in, it's even further down. So there has been changes in expectations which have been unprecedented. And what I was talking about before, about the asymmetric monetary stance, here I have the different cycles of hiking and cutting since 1970s. And the last time there has been a true sustained hiking rate, it has been the Volcker year in the late 1970s to kill inflation. It is the second big green line there. After that, you can see, even before the Greenspan put, we have had an extremely asymmetric pattern of cuts and rate hikes, cuts and rate hikes. The rate hikes have never brought us back again to what we were before. So this puts a lot, I mean, whenever we talk about factors, whenever we talk about expectations, whenever we talk about risk premium, normally we do not take into account that there is a player with virtually infinite monetary resources in the market that can distort all this game. This, to me, this ratchet game, this fact that there is this intrinsic asymmetry, again, the graph here is pre-COVID. If I put COVID, I have another drop of a shoe going down. The asymmetric nature of risk favors cuts over hikes. The new Fed policy requires inflation beyond reasonable doubt, not on the balance of probability, to raise rates. Therefore, normalization of rates is a very long way off. Of course, rates as well should reflect fundamentals. The riskless rate should have an impatient component, and then, apart from your risk aversion coefficient eta, should reflect the expectation of growth in the economy. I hope, since we are talking about real rates here, I hope that that is not the case. Otherwise, the expectation about the growth of the economy for the next 20, 30 years, it is zero. And on top of this, we have probably had in the last 4 years greater political interference in the conduct of monetary operations than we have observed in the last decades. The implications for factor investing are serious. Normal factor investing is a very long way off. Normal factor investing relies on the fact that the prices reflect expectation of the cash flows and the compensation for taking that risk. All of this is completely out of the window, which therefore doesn't surprise me why factor investing is going through such a difficult period. One way of describing what the central banks have been doing is creating controlled asset bubbles. Perhaps they had no other choice, but that is what they have been doing. So probably one way I look at, especially in fixed income, but in all areas, I would say, strategies now is, are some bubbles less inflated than others? When I used to be at PIMCO, Bill Gross used to say in similar situations, the game now is picking the best looking horse in the soap factory. This brings to the fore relative value trades, long short portfolios. And we all know the difficulties and the dangers. First of all, we're looking at second order effects. We need large notional. We have liquidity constraints. We have leverage trades. And as previous speaker was saying, probably this is not the best moment in time to leverage a lot. And we are naturally buying illiquidity. Relative value trade are a challenge for factor investing, but I would say probably they are the only game in town at the moment. So it is a tough moment for factor investing, for proper factor investing. I'm not surprised it is, and I'm happy to take questions.
Great stuff, Riccardo. We had one question from the audience, which is, how will the factor investing community get their heads around the negative rates when levered risk parity is effectively selling OTM puts, and these trades will have to be unwound when those puts go into the money?
That's a very good question. That's a very good question. To me, it is again, it is very difficult to answer this question, because the natural way to approach is to think in terms, what are expectations about rates or about fundamentals, etc., where everything is actually driven by what are the monetary actions going to be. One very, very important thing, all the signals that we have had in the past about value in fixed income, which was, say, the slope, just take the simplest one, has been completely subverted by monetary easing, quantitative easing. Because in times of quantitative easing, in a moment of distress, you have the opposite signal to what we had in the past. So I wish I had a convincing answer. Although all I can say is it has become a guessing game of monetary policy more than anything else, but not just in fixed income, as the S&P picture shows.
Great stuff. Well, yes, that's about all we have time for. But yeah, massive thanks, Riccardo. That was really insightful. Much appreciated.